Austin Braun here, certified financial planner at Edgewater Family Wealth, reaching out with two quick updates. First, invites are going to be going out soon, if they haven't already, for our Sanford Zoo event coming up. So we look forward to hopefully hosting you and your family. Second, get some thoughts on the market out there. There's obviously a lot going on. The market has weathered thus far a lot of headline risks so far between Ukraine, COVID, lockdowns in China, fear of slowing global momentum, and concerns of aggressive tightening on behalf of the Fed. So the bad news is that there's no denying that there's a lot of risks out there to the economy and the global financial markets, especially as COVID starts to pick up in China. That could cause additional issues with the supply chain. And then if we look in Russia and Ukraine, the war extending into its third month, potential issues with the commodity markets. But here's the good news. The storm may soon pass as we near what we consider could be maximum pressure points on inflation, Fed hawkishness, long-term rates, and we're potentially starting to see an inflection point specific to supply chain disruptions. So to talk about the R word, which is recession, by definition, a recession is a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 successive quarters. So that's the important part right there. It's generally identified by a drop in GDP for 2 successive quarters. Here's what it doesn't mean. It doesn't necessarily mean 1929 to 1938, which was the Great Depression. Doesn't necessarily mean the 2008 to 2009 Great Recession. It means 2 successive quarters of negative GDP. So let's talk about GDP. If we look at GDP estimates for this last quarter, estimates were coming in at about 1.1%, but actually came in at a negative 1.4%. While this obviously was not what we were hoping for, there's 2 important things to remember. First, GDP is backward looking. If you look back at the first quarter of this year, in the not too distant past, we hit peak COVID so far. So we suffered the worst surge in COVID cases yet. And then the Russia-Ukraine war also started in this past quarter. Second thing to keep in mind is there's evidence that there's strength right now in personal consumption. There's strength in business expense or expenditure, and that has carried over to this quarter. So if we look at real-time activity metrics, which consists, for example, of people starting to travel again, they're positive. The labor market conditions continue to improve, and people are out spending money. Companies are also spending money, which should support a positive backdrop for equities. Also, we have to keep things in context specific to the Fed. So if we go back to pre-COVID, we had just gone through the longest expansion on record. The Fed had started to increase rates prior to the COVID-19 pandemic. During the pandemic, the Fed was able to take a number of unprecedented actions to keep the economy afoot and avoid what could have been the worst case scenario. So now that the economy is on solid footing, what's happening is the Fed is repositioning itself because it has the flexibility to do so, and the economy is currently supportive enough for them to do it. So that is all to say that as investors, we should actually feel some comfort that the Fed is taking steps to tighten things up, because the last thing we want is for the tide to go out and for the Fed to be caught without a bathing suit on. Fed's basically putting their bathing suit back on. Finally, a quick note on earnings. We're going through what has turned out to be a pretty robust earnings season. There's a silver lining in there, and while you've got companies, high-profile companies such as Amazon, that have disappointed in earnings, there is a commonality between these high-profile companies that are disappointing, which is they were beneficiaries of the stay-at-home trade. And the stay-at-home trade is getting a little tired. So in aggregate, this earnings season has actually been pretty positive. The economy's on solid footing, and companies are putting out pretty healthy numbers. One of the most notable trends specific to earnings looking forward is typically at this time in the year, companies are revising down about 3.1%. They're actually revising up about 2.8%. Now, none of this is to say that tomorrow we should expect things to clear up by any means. The reality is we expect things to remain choppy as the war in Russia and Ukraine continues to play out. The Fed communicates its plans about what they're planning to do specific to interest rates. But we know that there's a price associated with long-term market performance. Right now, we're paying the price. If you're willing to stomach this in the short term, over the long term, 100 years of stock market history tells us you will continue to be rewarded. If you have any questions or want to chat, absolutely feel free to reach out.